Hi everyone and welcome to ACCA P4 live session. Last time we were doing mergers and acquisitions. We saw acquisition type 1, acquisition type 2, and we also saw acquisition type 3. We said the type of acquisition would determine how to calculate the value of the company as the present value of the free cash flows using the WACC as the discount factor. So where it is acquisition type 1, business risk and financial risk are going to stay the same. So whilst they're going to stay the same, then there's no need for us to change our WACC, because we said WACC will reflect business and financial risk. So if as a result of the acquisition, the business risk and the financial risk is not going to change, then straightforward, our current WACC is appropriate. The moment the business risk or the financial risk or both are changing, then there's the need for us to calculate a specific WACC. So acquisition type 1 told us that as a result of A acquiring B, business risk and financial risk is going to stay the same. And as a result, our current WACC is appropriate. Acquisition type 2 is a situation where business risk is going to stay as it is, but financial risk is changing. Therefore, we have to evaluate it on the basis of separating cash flows in relation to business from cash flows in relation to financing. And we said where the business risk is staying the same and the financial risk is changing, we would have to think of using the adjusted present values as a way of trying to evaluate the business combination. And we saw a calculation on it last week. Now we're going to look at acquisition type 3. And then we move on to our hedging because we are behind one session or some few topics. So let's see, acquisition type 3. Acquisition type 3, business risk and financial risk is going to change. If business risk and financial risk is going to change as a result of the business combination, then obviously the WACC is not going to be appropriate. What will be the WACC we would have to use to discount the cash flows? Now bear with me. This is your focal point. Examiner has created so many questions out of this, and this is the one you are most likely to see in the exam room. For the acquisition to be successful, the value of the combined business should be greater than the value of A plus the value of B. So the examiner can tell you, calculate the maximum premium, calculate the value of the synergy, assess whether the acquisition is going to be successful. All of them, this is your focal point. Is the acquisition going to be successful? Calculate the maximum premium we have to pay, calculate the maximum value we would have to pay, calculate the amount of the synergy. All of them are the same. You have to calculate the value of each of the companies and the value of the combined. How will you calculate the value of each of the companies? So far, so good. We've learned so many methods. We've learned the dividend valuation. We've learned the PE ratios. We've learned the free cash flows. As I keep saying, the free cash flow becomes the common method of valuing the company. So if I want to get the value of the combined business, the value of A and value of B, I will need my free cash flow of A and then WACC of A. I will also need the free cash flow of B and then WACC of B. And then I will need the free cash flow of the combined business and then the WACC of the combined business. I'm leading you towards something good in the exam room because the lecture note, we are building some assumption in here. So this is your framework. Is the acquisition going to be successful? It will only be successful if the value of A, B is greater than A plus B. So assuming A is 20, B is 10, and this is, let's say, 40. It means the business combination will bring in increase in value, will bring in extra value of the 40 minus the sum of these two, which is 30, and that extra value is given is 10. So the maximum premium A can pay to take over B is to give her the whole benefit to B. So that's the maximum premium. The total amount A can pay to B is B value is 10 plus the maximum premium, so that it will be 20. So when you add the 20 to this 20, you get the 40. So A shareholders at worst will maintain their wealth of the 20. Okay, so the examiner can tell you, is it going to be successful? It will be successful if it will create what? Synergy. The value of the synergy is the same 10. The maximum premium we should pay is the same 10. Maximum amount they should pay to take over B is going to be this 10 premium plus the value of B. Okay, how do I get these values? So many ways, as I've said. First one is you need to think of getting the free cash flows of A discounted using WACC of A. Free cash flows of B discounted using WACC of B. WACC of the combined free cash flows of the B. If you are lucky enough, as the examiner does sometimes, and the examiner gives you the value of A and B, okay, or give you the value of AB, A and B, life is straightforward, which normally what he does is he will give you the value of A and give you the value of B, and you will be called upon to calculate the value of the AB. Or he gives you the value of A and you are called upon to calculate the value of AB and value of B before you be able to do this analysis. Now, if I have to use the free cash flows to calculate the value of AB, I will need the value free cash flows of AB and I will need the WACC of AB. How do I calculate the WACC of AB? We know it already. That's why I told you last week. Refresh your mind on how to calculate the WACC of combined activity. Because now I have combined two companies, A and B. So the WACC here of the AB should reflect the business risk of the AB and the financial risk of the AB. Okay? The business risk of the AB will be the business risk of company A plus the business risk of company B. But the financial risk obviously will combine the debt equity of the combined business. That's it. Okay, so it's like you following the same principle as WACC of combined what activities. If the examiner wants to give the figures to you, brilliant, but he doesn't normally give it to you, you will be called upon to do that. If you want to be funny, he's not giving you any value. You have to calculate value of A, value of B, and value of AB. So where the business combination will result into change in business risk and change in financial risk, then our WACC for the combined business is going to change to reflect the business risk of the two companies combined and the new debt equity proportion of the new company. That will give you the WACC of the new company or combined company. You discount the cash flows of the combined business using that particular WACC. So that is what we're going to do. Okay, so let's straightforward go to our lecture note and then we will pick it from there. Okay, so if we go to our lecture note here, we're going to see this Edwards as an example. Edward PLC. Edward PLC is considering the acquisition of 100% stake in Coleman Limited in order to achieve backward vertical integration. Considerable savings are anticipated due to the combination of both the marketing operations and distribution networks of the two companies. Therefore, synergies will arise to create cash flows which are in excess of the current estimated cash flows of the two separate companies. Upon the acquisition of Coleman Limited, Edward PLC will immediately sell one of the warehouses of the target company, providing instant cash inflows of 5 million. The forecast cash inflows of the merged business are as follows. Year 2008 up to 2018. These are the cash flows. The forecast rate of corporation tax is expected to remain at 30%. The risk-free rate of interest is to be taken at 5%, and the expected return on the market portfolio is 9%. Information currently relating to the two companies is as follows. Edward, Coleman, market value, debt, equity, total, beta asset, cost of debt. Edwards PLC plans to make a cash offer of 380 million for the purchase of the entire share capital of Coleman Limited. This cash offer will be funded by additional borrowing undertaken by Edward PLC. advise the directors of Edward PLC whether to proceed with the acquisition. They will only proceed with the acquisition if it is going to be successful. And for the acquisition to be successful, this is your framework. The value of the combined business should be more than the sum of the individual part. I would need market value of Edwards. I would need market value of Coleman, and I would need the market value of the combined, and you look at the movement. So when you go to the question, you need to ask the question, where is the market value of Edwards? Where is the market value of Coleman? If they are given, you pick them. Given this question, they have given them the market value of equity and debt of Edwards is sum up to be 1 million or 1,000 there, and that of Coleman is 300. So I have got the value of A and B. I have got the values of A and B in here. Now I would need the value of the combined. To get the value of the combined, look at the template, because this one we've just summarize it for you, even though some of the questions the examiner will give you this and give you that. If they don't give it to you, it's your responsibility to calculate them as the free cash flow of each of the companies discounted using the WACC as I've illustrated on the framework for you. So if they give it to you, you pick them. So now, as they've given those figures to me, I have got my value of Edwards plus value of Coleman. They told me value of Edwards is 1,000 plus value of Coleman is 300. Now, what is the value of Edward and Coleman combined? And we said this figure should be greater than that. So I have got this, I have got that. Therefore, I need to get the value of the combined. How will I get the value of the combined? I need to get the free cash flow of the combined and discount with the WACC. The lecture note is prepared here on the assumption that you know how to calculate free cash flows because we've done them already. So here, what we did was we gave you the free cash flows of the combined business. That is why if you look here, he's saying that the forecast cash inflows of the merged business are as follows. Okay, sometimes the examiner will not give this one straight to you. You would have to calculate the free cash flows of the combined. And we all know free cash flow is the operating profit less tax, add non-cash items like depreciation to capital allowance, less increase in working capital, and then less what? Your fixed capital. So if they don't give the free cash flow or net cash flows to you like this, and they give you accounting information, you know how to calculate that free cash flow. Calculate that free cash flow and discount it using the WACC. So this is your template. This is your template. If this one wasn't given, I would have to get the free cash flow and WACC of this in order to come and get the corporate value. Get the free cash flows of that, WACC of that to come and get the corporate value. But they were given to us. So once given, I am happy. I would just need for the combined. And the combined should be the free cash flow of the combined, which is also given. I will need the WACC of the combined. The WACC of the combined is not given in the question. So I would have to calculate the WACC of the combined. And that is the framework I gave to you. The WACC of the combined should reflect the business risk of each of the companies, and then financial risk of the combined business. So first, what will be the stages? It is just like you calculating the WACC of a combined activity. It's the same thing that we're doing here. So first, look for a proxy beta. Look for the proxy beta, and the proxy beta, you have to pick it from each of the companies involved. So I have got Edwards and Coleman. So Edwards proxy beta, the equity beta of Edwards is given as 0.9 and that of Coleman is 2.4. You need to ask yourself, this beta I have picked, are you geared or ungeared? What I'm looking for is the business risk associated with Edwards and business risk associated with Coleman. If you go to the question, the betas given, they said beta asset, and we all said that asset beta measures only business risk, and as such asset beta is an ungeared beta. Therefore, we will say this is an asset beta which is ungeared. So if this is ungeared, it is measuring only business risk. there is no need for me to ungear again. There is no need because the examiner had already ungeared for me. Even though the companies are having what? Debt. Even though the companies are having debt, because they have specified that it is asset beta, it is measuring only their business risk. No need for you to ungear again. Therefore, if I have got the asset betas, which measures their respective business risk, that is the business risk I will face. So what will be my combined business risk? And that is what is called the combined asset beta. We saw this when we did the combined WACC or WACC of combined activities, and we said the combined asset beta should be the weighted average of the asset betas of each of the companies or each of the activities, weighting them with respect to their market values. So I will say Edwards and then Coleman. What is the combined asset beta? Edwards equity beta and geared is 0.9 plus Coleman's is 2.4. What is their respective market values? Edwards, according to the question, Edwards market value total is 1,000, Coleman is 300. Therefore, I am going to say this is 1,000 and this is 300. Sum up the two, it gives me 1,003, 1,003. So that is the weighted average on the basis of their respective market values. And when you sum up this, you get the combined asset beta. You get a combined asset beta of 1.25. So this is measuring the business risk of the combined business. Okay, as I showed you here, you need the business risk of each of the companies, weigh them together to come and get the business risk of the combined. And when you get the business risk of the combined, you ask, are we going to have financial risk? I will have financial risk if the combined business will have debt. So what is the debt equity of the combined business? Okay, it follows the same stages. So will this combined business have debt? They didn't tell us we're paying any debt as a result of the combination, so they will still have the debt. And Edwards is going to bring in extra debt of 380. So when we combine, what will be the total debt and equity? So let's go and calculate the debt and equity. As long as they will have debt, we would have to re-gear. Okay, so what will be the equity and what will be the debt? The equity of Coleman is and Edwards is 900 plus Coleman of 280, and that is 1180, and debt is 100 plus the 20, and don't forget that they are going to raise 380, and that is going to be 500. So the combination will bring a total debt equity of 1180 and 500. What should we do? We would have to re-gear to reflect that. And according to Miller and Modigliani, the asset beta is equals to the equity beta geared, equity over equity plus debt, 1 minus the T. Therefore, what will be my asset beta given? The asset beta of the combined business is what we calculated as 1.25. So I'm going to have the 1.25 is equals to the equity beta geared. The equity is 1180 plus the 500, 1 minus T. Tax rate, they said tax rate is given as, is it 30%? So this is 0.7. And what will be your equity beta geared? When you solve it mathematically, you come and get the 1.62. If I get the 1.62, I have to put it in the CAPM to get the cost of equity of the combined business. And that is the risk-free rate, they said is 5%, plus the 1.62, the equity risk premium, or let's say the market risk, the market return was given as 9%, and the risk-free is 5%. So the equity risk premium or market risk premium is 4%. When you put it in there, you're going to get cost of equity of 11.48%. Now, having got 11.48%, we have to calculate the combined WACC. And the combined WACC is the weighted average of the cost of equity and the cost of debt, which is 11.48. Equity represent 1180 plus the cost of the debt. Okay, what is the cost of the debt? If you go there, all the companies are raising money at cost of debt of 7%. So my cost of debt is 7% into bracket. Don't forget about the tax effect, and that total figure is 500. So when I sum up the two, is it 1680? 1680. So if you know how to do WACC of combined activity, you know how to calculate WACC of combined business. Just roll it over, okay? And that WACC is going to be 9.52%. Okay, so if I get the WACC of the combined business, I have to discount the cash flows or the free cash flows of the combined business to get the corporate value of the combined business. So this is your focal point. This is your focal point. Get the value for each of them and the value of the combined. Now I've got the free cash flow of the combined. I've got the WACC of the combined. What should I do? I need to discount that. And that one, I'm taking you straight to your lecture note. You will see. Okay, so whatever I'm doing now is something we have done previously. So make sure you go to that. Okay, if there is difference in the cost of debt, then you definitely have to do an adjustment in here. So this, assuming there was different cost of debt, I would have done 11.48%. Equity is 1180 divided by 1680 plus, let's say Edward's debt was 8%. I would have done 8%, 0.7. Edward's debt, as given the debt here, where is the debt equity? Given the debt here, Edward's debt is 100, and then the 380, which is 480. And Coleman's debt is 20. So I will say Edward's debt, which is 8%, is total of the 480 plus Coleman's debt, which is 7%. Don't forget about the tax, and this one will represent what? 20 is the weighted average. And when you sum up all of that, this one will give you the 1680, and you calculate the WACC. Okay, so that is how it should be. You don't need this here, but if it is the same, there's no need for you to do 7% there and 7% there. Brilliant. So now let's go to our note, and then we pick this one to illustrate quickly. So if you get the WACC of the combined business, just as we did with combined activities, then the cash flows, the free cash flows of the combined business will be discounted using your WACC of the combined. And everybody knows how to do discount factor, so I'm not going to bother myself. In the exam room, you can approximate this one to 10%. So when you read the 10%, you discount it with the cash flows, and you come and get the value of the combined. When you get the value of the combined, I would have to emphasize, if you look at what we did in chapter number 2, in calculating the present value of the free cash flow, that is what your mind should be on. Because here we are making an assumption, we have already taught you that. So go to the chapter number 2, derive your free cash flow. I think when we were doing in chapter number 2, because we haven't taught you WACC, we gave you the WACC. Here, we are not going to give you the WACC unless you are lucky so far as P4 exam is concerned. So if you see that the WACC is not given, it's your job to calculate the combined WACC. When you get the combined WACC, you determine your free cash flows, you discount it. Examiner can say year 1 to year 4, and then from year 5 to infinity, it becomes a constant perpetuity or a perpetuity with growth. All those timing horizon we did with respect to chapter number 2 and free cash flow is applicable here. But here we are balancing the time because we don't have to go through all those again. So if I get the free cash flow, I discount them using the WACC of the combined, I have got the corporate value. My corporate value is 1422.76. And we all said corporate value is equals to value of equity plus value of debt. So if my corporate value is 1422.76 and the value of debt is 500, then value of equity will now be 922.76. Originally, if you look at the question, Coleman's equity was having a value of 900. Therefore, if after it is now 922.76, then we are going to say that we have been able to increase their wealth by 22.76, and as such, this acquisition is going to be what? Successful. Okay, normally this is too long for you to think of. What they will do, or you are likely to do in the room, is we said the value of the combined is 1442.76 is greater than the 1,300 plus the 300. Therefore, overall, we are increasing the wealth by this minus the 1,003, which is 122.76. Okay, so given this, it means there was a premium payment with respect to the equity. Therefore, that is where you see the 22 only for that of Edwards shareholders, Okay, so that is basically the case. Now, what I am interested in here is this. Examiner might further ask you a very theoretical or discursive question in here. That, do you see a problem in here? There's a problem in here in the sense that when we were calculating the WACC, look at the debt equity we used. We used equity of 1180. Yes, that amount is the total premium that you can pay. Yes. So the maximum premium we can pay is to give everything to them. So your maximum premium here will be 122.76, so that Edwards will maintain its worth 900. The maximum premium will be the 122.76, whatever amount we would have to get. So the whole of the 122.76 will be given to Coleman, okay? Will be given to Coleman. To be honest, this very question is achieving a different objective, but normal exams question will achieve this objective that I'm trying to do here. So your maximum premium is that the combined business is 1422.76, and the sum of the individual part is the 1,003. So it's creating a value of 122.76. So for that of Coleman, for that of Edwards to maintain its value, then all this is supposed to be given to Edwards. And as such, we're going to have 300 plus 122.76. So the maximum premium is that, and the maximum amount will be 422.76. So that Edwards will still maintain its value of the 1,000. Edwards will still maintain its value of 1,000. And remember, what is going to happen here is that out of the 1,000, there is debt of what? 100. So they will maintain their equity value of 900. Okay, so this is the framework you're going to do. But here, we also want to achieve a different objective. Okay, because some inconsistency had occurred. That inconsistency is that when we calculated the WACC, we used debt equity proportion of 1180 and 500. But after the calculation of the WACC, and we used that WACC to calculate the value of equity, we said the debt equity proportion is if the total value is this and value of debt is that, then the total value of equity is that. But the WACC calculations, we use here 500 as debt and equity of 1180. They are inconsistent to the debt equity ratio that came out of the market value. It is of this nature. I normally create a joke here that it is an issue of egg and chicken issue. Which one comes first? This is what I normally use to explain the basic one. For instance, if I have to calculate cost of equity, I'll say dividend divided by P0, meaning to calculate cost of equity, I need market value. The same way, if I have to calculate market value, I say dividend divided by cost of equity. To calculate market value, I also need cost of equity. Which one comes first? Okay, market value depends on the cost of equity or cost of capital. Cost of capital also depends on the market value. Which one comes first? So that is the argument. So the examiner might ask you to write this bit as discussion, asking you that when we do the business combination, is it going to have an effect on the market value and the debt equity proportion? And if that happens, what will you do? Okay, the problem here is that the debt equity proportion we use to calculate the WACC is not the same as the debt equity proportion that we got after we have discounted the cash flows with that WACC, because it's telling us here that the equity market value is 922 and that of debt is 500. But when we were calculating the WACC, we said the market value of debt is 500 and equity value is 1180. There is inconsistency. Okay, so this is where the examiner will tap you. When we do this, what will be the implications? The implication will be that there might be inconsistency between the debt equity proportion used to value or calculate the WACC and the debt equity proportion that came out as a result of the corporate value. So in that case, what should we do? Okay, that is what we've done here for you. When that inconsistency occurs, the solution to it is for us to use what is called the iterative revaluation procedure. The iterative revaluation procedure. What is the meaning? The meaning is that we would have to use try and error. We would have to use try and error such that we will get a debt equity proportion that will be used to calculate the WACC. So that when we get that debt equity proportion that will calculate this WACC, and we use this WACC to discount the cash flows, it will also give us a market value here that will also give us the same debt equity proportion. All what we are trying to say here is we want to remove the element of that inconsistency. The debt equity proportion for the WACC should be the same as the debt equity proportion as a result of the market value having used the WACC to discount the cash flows. How would we do it? It's a try and error. So we are going to revalue and revalue and revalue. That is why they call it iteration. Iterative revaluation. You are just going to iterate, do it, revalue, revalue, revalue for you to get a debt equity proportion for the WACC, which is consistent with the debt equity proportion that will come out of the market value. The good news is that it's a computerized program. We cannot do it manually. So ACCA is not expecting you to know that calculation. All what they are expecting you to know is to know the movement, that this is what will happen. It's a discursive element. Okay, we use the SL to do that. So if you come to your note, we try to use the SL to do this bit for you. We try to use the SL to do this bit for you. What I tell students is you don't bother yourself to learn it, because the examiner is not going to tell you to do that. Okay, you are not supposed to revalue and revalue. You can't do it there. It's an SL program. So we use this to try to illustrate. So when we did that using the SL program, we were able to get a WACC of this. And this WACC will give you your debt equity proportion that will bring you to the same word level. And that is that you see the equity proportion and the debt, and that is the market value. You don't need that. So I'll tell you this is for illustrative purposes. It's not in your syllables. So all what you need to know is that when that inconsistency occurs, because debt equity for WACC and debt equity for market values are different, you would have to use the iterative revaluation principle to revalue till you get debt equity which is consistent in terms of the WACC and in terms of the market value. This is basically the case. Some of the questions, the examiner even don't go further to ask you to talk about the iterative revaluation procedure. He will just have to tell you to calculate the synergy or the amount of the premium, or whether the acquisition is going to be successful in that case. So this is basically your acquisition type 3, and that is the most common one that occurs. And what I tell students here is that you know all of them, because you know how to generate free cash flows in chapter 2. You know how to calculate WACC of combined activities when we did the WACC. So it's a matter of bringing those two topics together. When you get here, roll over. The rest is the examiner's imaginations, how he will do it. Is he going to give you the market value of A and B and tell you to calculate the market value of the combined? Or is he going to ask you to calculate the market value of A, market value of B, market value of the combined? So revision, I will take a question that will actually handle all of that. Okay, so now let's go to high growth startups. Okay, high growth startups. What do we mean by high growth startups? Your syllabus want you to appreciate. Okay, your syllabus want you to appreciate the difficulties you might face when you have to value or calculate the market value of a company that has just started up and their intention is to grow what? Quickly. Okay, that's the name, high growth startups. The valuation here is very difficult because this company, they just started operations, and most of these companies that are having the intentions to grow quickly, they are not paying any dividend. Any monies that they will get by way of profit, they want to retain. Dividend valuation will not be appropriate to do it now. Most of these companies, when they start, they are making losses. And losses, you can't think of using PE ratio approach, because we said PE ratio approach is PE ratio multiplied by earnings per share. So if the company is making a loss, then it's going to be loss per share. And PE ratio multiplied by loss per share will give you a market price which is negative. So it means if I'm coming to buy your company, you would have to pay me, which won't happen, isn't it? And these companies, because they haven't been there for a very long time, they haven't got enough past base, and without enough past base, trying to predict something for the future in terms of free cash flow in the future is still going to be extremely difficult. Most of these managers are not technically experienced that they will be able to come out with that. So there are so many difficulties associated with you actually valuing a company which is a startup. But should you be able to try to forecast something and you want to calculate a growth rate for the future, because there is no much past information, if you remember, the growth rate we said should be calculated using the average method or the Gordon's growth model. Okay, and we said Gordon's growth model said the G is equals to RB, and the average method said D0 DN 1 over N minus G, if you remember. And this average method is used when past information is given. Where is that past information to be used? So normally, startups like this, their growth rate is calculated using the Gordon's growth model, which is G is equals to RB. R is the return on the investment, and B is the proportion of the profit retained. What will be the profit retained? Such companies, because they want to grow quickly, most of the profit or 100% of the profit is retained. Therefore, their B is more likely to be 100%, and R is their return on the investment. So basically, because B is 100%, their growth rate is equals to their return on investment, because whatever return they get on the investment, they put it in the company. So their growth rate will simply be equals to the return on investment, and B is always equals to what? 1. Okay, let's take this question to simplify the whole issue. This question has got nothing to do technically with high growth startup. They just brought there to bring understanding. Okay, Bednar PLC anticipate cost of 1,200 million in the coming year, thereafter growing at the rate of 4% per annum. The anticipated revenue for that year are expected to be 320 million. The company expects to achieve a return on reinvested funds of between 16% and 18% per annum. Furthermore, the directors of Bednar PLC do not anticipate the payment of any dividend for the foreseeable future. Okay. If there is a loss, obviously it's a negative figure. Therefore, you cannot use it to value it. It means you are going to give the company a negative what? Market value, which won't happen. Okay. The worst case scenario is that the shareholders are supposed to lose their investment. The company should liquidate. You won't call upon the shareholders to come and pay any extra money whilst the company is liquidating. Okay, so using a cost of equity of 20% per annum produce evaluation for Bednar PLC based upon both the maximum and the minimum growth rate predictions using the growth model combined with the Gordon's growth approximations. Okay, now the value of the company is the present value of the future cash flows. They said they've got a cost of 1,200 million in the coming year. And we all know that it is D01 plus the growth rate, which is the same as D1, which is the next year. So if they say coming year, it means this is what they've given to us. And this is the sales too. The cost is expected to grow by 4%. And the sales is expected to grow by the growth rate, either at a rate of 16% or what? 18%. That is the maximum return. If that is the maximum return, and this is a startup, we said we're going to calculate it as G is equals to RB. And B should always be equals to the 100% because we are reinvesting everything. So our R should be equals to the G. So now let's take this as to illustrate. If B is equals to 1%, then our growth rate, if we take the maximum growth of 18%, our growth rate will be equals to that 18%. And look, because the cost is growing at 4%, but the revenue and activities are growing at 18%. I cannot set this one against that. I have to do the PVs differently. So the revenue of 320 next year, it means they've done the D1 for me. And cost of equity is 20%. The growth rate is 18% minus the cost effect, which is 1,200 next year, and cost of capital is 20% and the growth rate is 4%. We normally combine them because we assume that the costs and then the revenue will all grow at the same rate. If they are not growing at the same rate, you cannot do that. You need to separate the cash flows, okay, and bring them their respective growth, and that will give you the market value of the company. We use the same principle. Now it is 16%, so the growth rate will be 16%, and then you do that. That will also bring you the 500 million. As I said, you don't necessarily need this for only startups. Everywhere you are calculating the value. If the question tells you that this company is reinvesting all the monies, then their growth rate is equals to return on investment. RBB becomes what? 100%. So have a look at that. I am going to move you straight to the hedging. Okay, chapter number 10 is only the discursive bit which you can read. I will definitely have to be doing the hedgings with you because whether you like it or not, the hedging is also waiting. So definitely I would have to prompt it. If you go to your structure, the other bit, you would have to listen to the videos. If you happen to get any problem, you can send me through email and I'm more than happy to reply. Some of you are doing brilliantly by sending a lot of questions, which I'm very, very happy answering them, because that is the indication to me that they are learning, because there are definitely challenges in there. There are definitely challenges in there. Some of you that you haven't requested for the list of questions I would like you to practice. I've got a list of questions in there. So if you want it, you can send me the email and then I can forward the list of questions, must, should, and could questions that you can go through in your private studies. Okay, so I am moving you straight to the hedging, and then we pick the hedging straightforward from chapter number 15. So the intervening chapters in there, try to read them. But the revision, what do I do? In the revision, I try to pick questions that will cut across all that. So capital reconstruction schemes and all that I have left, I haven't left you behind. You listen to the videos. When we come to the revision, you see me solving questions. And when I'm solving those questions, I'll give you the background, link you to the node before I will start solving the questions. So everything that I'll leave here, it is still going to be considered during the revision. So let's see. Hedging of foreign exchange. I told you the very first day, there's no P4 exams without hedging. And the hedging will come from interest rate and then currency or exchange rate risk. If I have to predict, which normally I don't want to do this analysis here, okay, if you look at what the current examiner has been doing very often these days. If this setting is interest rate, the following setting becomes what? Exchange rate. Okay, so if you look at the June 2014, it was currency, and then December 2014, it was interest rate. June 2013, it was currency, and December 2013, it was interest rate. So if the past information can be used to predict the future, then I would have said that the June 2015, the hedging question should come from currency. But my advice is such a prediction, if it happens to fail, because it's risk analysis, if it happens to fail, you're going to be in trouble, because definitely one of the questions there is on hedging. Okay, one of the questions there is on hedging. So you would have to make sure that you are okay with the hedging. You would have to make sure you are okay with the hedging. So if you predict this and the other one comes, you are in trouble. So please hedge yourself against the hedging. Definitely go for it. So now let's see what is exchange rate risk or currency risk. I'm quickly going to go through this F9 stuff and then we move on to the higher level. Exchange rate risk. What is an exchange rate? Exchange rate is the price at which one currency will be converted to another currency. I normally use the price instead of the rate, okay, because I will use that price in my analysis further. So exchange rate is the price or the rate at which one currency will be converted to another currency. Exchange rates are normally quoted as a variable currency and a base currency. What is the variable currency and what is the base currency? For example, if we say dollar slash the pound, the currency sign that comes after the slash is your base, okay? And the currency sign that comes before the slash is your variable currency. So here, the dollar is the variable currency and the pound is the base or the fixed currency, or they will say the base currency, okay? So if I say dollar slash pound 1.5, I'm telling you $1.5 is equals to the 1 pound. So the dollar is what is supposed to be changing, whether it's appreciating or it's what? Depreciating. So that is the thing that you need to pick. The next one is bid and offer prices. What is the bid? If you go to the bank manager to convert your currency to another currency, bank manager will say, we buy at, we sell at. The biggest question is, what do we buy at and what do we sell at? Because if I've quoted dollar slash pounds, there are two currencies, dollar and pound. Which one are they buying at and which one are they selling at? The common sense here is that this is their base. So indirectly, the bank manager is telling you, we buy the base currency at and we sell the base currency at. So if it is dollar slash the pound, we buy the pounds at the bid and we sell the pound at the offer. We offer the pound at the offer and we buy the pounds at the bid. I know it's confusing a lot of people from F9 up to this level. Here, it shouldn't be part of the argument because there's more further analysis than that. Therefore, my advice to you is just ask yourself, what is the dealer going to do with the base currency? If the dealer is taking the base currency from you, then bid it. If the dealer is giving you the base currency, there's no other English word easier than he is offering it to you, okay? The offer should always be higher than the bid. And the difference between that offer and the bid is what is called the spread, which covers the profit of the risk that he is actually undertaking. And the spread, the offer should always be higher than the bid. Spot and forward rate. What is the spot rate? Spot rate is the rate that is determined now, for which the actual exchange of the currencies will happen now. Forward rate is the rate that is determined now, but the actual exchange of the currencies will occur on a future date. We determine the rate now forward, or we determine the rate now for forward exchange. Okay, so that is that. Spot rate is determined now. currencies will be exchanged now. Forward rate determined now. Currencies will be exchanged on a future date. Now, what is outright quotation and point quotation? Outright quotation is where the exchange rate are quoted to show all the decimal places, like what they've done here. So if I say dollar / the pound, that is the movement. We have shown you all of the exchange rate movement. This is your spot rate. This is what? 1 month forward rate. So it means if I want to get money in dollars or pounds in 1 month's time and I'm worried about the exchange rate, I will go to the bank now and I will agree this 1 month forward rate with the bank. Whatever the exchange rate will be in a month's time, we are not worried because we have already pegged the exchange rate in the 1 month forward rate today. Okay, so that is the forward rate. However, sometimes instead of quoting the exchange rate in terms of outright, they quote it in terms of point. And what is that point quotation? So if the forward rate is quoted at point quotation is the forward rate as a deviation from the spot rate. So the difference between the spot rate and the forward rate is what is quoted as the point. So what they are telling you here is that if the spot rate is this and 1 month forward rate premium here, which I'm going to talk about, that is that tells you straightforward that the forward rate is point, because you can't say $1.4432 is equals to 1 pound and 1 month's time is $58 is equals to 1 pound. Though it's strange to happen, but you need to remember the moment you see the premium or discount in here, then it means that it is given to you in point. You cannot convert the dollar into pounds using these. First, you would have to convert it into their outright before you be able to actually convert the currencies. How will you convert? We said the point is a deviation from the spot rate. Deviation, which is the difference, means it is either more or it is less. Examiner is not going to say more or less or plus or minus. No, they are going to use the finance terminologies. When a currency is at a premium, it means you need less of that currency for the same amount of the other currency. So when he put premium here, it means the forward rate is less than the spot rate by the figure given to you. So you need to deduct. So premium means you need less, therefore you would have to deduct. Discount means you need more, therefore you would have to add. So this is the common sense you are going to use. They are opposite to the normal day-to-day meaning of premium and discount. Normal day-to-day premium, we are adding. Normal day-to-day discount, we are deducting. But in currency terms, their meaning is opposite. In currency terms, when a currency is at a premium or the currency has appreciated, it means you need less of that currency for the same amount of the other currency. So deduct. So when you come here, you see that the examiner said this, premium. So once it's a premium, then we will need to deduct, and be with me. How are we deducting? We're not going to say 1.4432 minus 58. No way. Okay? This is how you have to deduct. You have to write from your right hand side towards your left. So this is 58. You bring the spot rate. The 8 should pair with the last figure here. So you see the 8 is pairing with the 2, 5 is pairing with the 3, and that is 58. So the rest you have to bring in 0, 0, 0, 0.0. And because it was at a premium, you would have to deduct. So 1.4432 minus 0.0058, and that is giving you that. It's the same thing you have to do for the other one. So remember, you don't deduct straightforward. You have to write from your right hand side towards your left. Whatever is left, represented by 0, 0 till you get to the point and the 0. So that is the point quotation converted to the outright quotation. You cannot exchange currencies using point. You would have to exchange using the outright. So when they give you the point, it's your job to convert it from the point to the outright, and we've seen how it works. What is the cross rate? What is cross rate? Cross rate is applicable when you want to get the exchange rate between two currencies and that exchange rate is not given to you. You can use their common relationship to a third currency to establish that exchange rate. Let me give an example. You want to convert, let's say, pounds to dollars, but dollar-pound exchange rate is not given to you, but you have been given the pound-euro exchange rate and the dollar-euro exchange rate. Because you wanted the pound-dollar exchange rate and it's not given, but the pound and the dollar, their relationship to a third currency, which is the euro, is given. You can use that relationship between the pound euro and the dollar euro to establish the exchange rate between the pound and the dollar. And that is what is called cross-rating. You cross-rate it. Examiner might not necessarily mention cross-rate. You will need to know that cross-rate should come up. Okay? This is the reason why I'm telling you, some of you haven't started working on some of the questions in your revision kit. For those who have started working on the investment appraisals, like the international investment appraisals, there's a question in the revision kit called BITIN PLC. Examiner tested the cross rating there. Okay, so those who have done it, questions are coming and I have already answered them for those who send those questions. So please, if you haven't started, don't wait to the last 2 weeks. That will be over because the P4, look, almost everything is interrelated. I need cross rate whilst we're doing the international investment appraisals. Look at where you did the international investment appraisals and look at where the cross rate is in your note. How do you bring the two together? Unless you have practiced and you've seen it. Otherwise, when you go to the exam room, you will not be able to bring these two things together. And this is what the examiner is always talking about, that students are not able to relate the topics to each other. Okay, so watch out. Start practicing now. Okay, so let's take this example. Example 4. If 1 yen is equals to $0.55 and 1 pound is equals to $1.6, and you need exchange rate between the yen and the pound, what will be the exchange rate? They haven't given it to me directly, but their common relationship is given to a third currency, which is the dollar. How will I get that? The common sense is if your 1 yen is equals to $0.55 and $1.6 is equals to 1 pound, how much will $1.6 be in yen? If I'm able to get the $1.6 in yen, it should give me the pound equivalent. So if 1 yen is equals to this dollar, how much will be $1.6 be in yen? I don't know. That figure is the same as the pound. So cross multiplication, so my x will be the $1.6 divided by 0.55. And that is what is giving us 2.9 yen. So 2.9 yen is giving you $1.6. So what we've said is 2.9 yen is equals to $1.6, and that same $1.6 is equals to 1 pound, implying that the 1 pound should be equals to 2.9 yen. And this is how you use to do the cross rate. And as I told you, the examiner might just be silent. You would have to do that. Okay, so that is basically that. If you look here, example 5, we're trying to bring your mind on how to use the bid and offer. I'm going to do one, and then you take on the rest because this is a primary school 10. Consider the following exchange rate, bid and offer. Dollar sterling, dollar slash the pound, sterling slash the euro. What will be received in pound sterling by a UK company expecting to receive $400,000? Okay. You are based in the you are based in the UK. You are expecting to receive $400,000. If you get the $400,000, you would have to bring it to your country, which is to convert it into pounds. You need the dollar-pound exchange rate, and that is what is given. This is the bid, and this is the offer. Because the quotation is $/ the pound is the base currency. So this dealer is telling you, or this bank is telling you, the pound being the base currency, I will buy pounds from you at this bid, and I'll give you or sell pounds to you at that offer price. So if I go there with the dollars and I need pounds from him, what is he going to do? He has to give me the pound. So he has to offer me the pound. So you have to use the offer rate. And that is why they use the offer rate here for you. What some people also do is that, oh, the bank will always win. I don't like this primary school thing so far as your P4 is concerned, because you haven't got the time. They will use all the two rate. So for instance, they will say the 400,000 divided by 1.4580. That is the bid price. So I'm going to have the 400,000 divided by 1.580, and that is giving 274,348 pounds. And they will say, okay, if you go to the bank manager with $400,000, will he want to give you 267 or will he want to give you 274 pounds? Obviously, the bank manager will want to make a profit, so he won't give you the more, he will give you the little. Okay, so that is that. They do all the two, and when they finish, they cancel this. You haven't got the time. You haven't. Okay, so if he is giving you, if the dealer is giving you the base currency, you have to offer it. If the dealer is taking it from you, you have to what? Bid it. The second is, what will be paid in pound sterling by a UK company expecting to pay $500,000? If I'm expecting to pay $500,000, it means I have to convert pounds into dollar. I will go to the dealer with the pound. Dealer says, I buy pound from you at the bid. I offer pounds at the offer rate. When I go there with pounds needing dollars, he will give me pounds. He's taking the pound for me, isn't it? He is taking the pound for me, and as such, I would have to simply what? Bid it. That's why they bid the two. Okay, if you have used the two rate, you will see he want to take more pounds from you than giving it to you. So you can follow with that to learn about those basic bid and offer. It shouldn't be an issue at P4 level at all. Okay, next, risk and foreign exchange. This is where the whole argument starts. Okay, risk and foreign exchange. When we talk about risk is of the fact that you might gain or you might lose depending on the movement. If it goes well, you win. If it goes bad, you lose. So foreign currency risk or foreign exchange risk is the gain or loss you will make as a result of movement in exchange rate. The moment the exchange rate moves, you are likely to make a gain or loss. That gain or loss due to that movement in exchange rate is what is called the exchange rate risk. And what will bring about that? When you enter into foreign currency transactions, denominated transactions, isn't it? As a way of you importing, as a way of you exporting, as a way of you having a manufacturing plant in another country, as a way of investing in another country, having a subsidiary in another country. All of them are examples. All these examples of what will bring about the gain or loss or the risk is what is called the transaction exposure, the economic exposure, and the translation exposure. Okay, I'm going to give you the definition clearly because one of the sittings, the examiner created 3 scenarios and students were supposed to identify which exposure or which foreign currency exposure or risk the company is facing. Get it clear. So your transaction exposure is simply measuring the gain or loss due to movement in exchange rate when your company enters into foreign currency denominated transaction, and settlement will occur on a future date. Be with me. It's a gain or loss due to movement in exchange rate that cut across all the exposures. But the transaction one will come when your company enters into a foreign currency denominated transaction and settlement is not occurring now, but settlement will occur on a future date. So if I am based in UK and I have to, let's say, buy goods from India and I have to pay in my pounds, even though I have entered into foreign transaction, that transaction is not denominated in foreign currency to me because I'm going to pay in pounds and I'm based in UK. That doesn't qualify for transaction exposure. I am based in UK. I'm buying goods from India. I have to pay in rupees, but that rupees will be paid now. If rupees will be paid now, settlement is occurring now. There's no movement in exchange rate. I won't make any transaction exposure. But if I'm based in UK, I've entered into transaction in India, I have to pay in the Indian rupee, but the payment will occur on a future day, let's say 3 months time. Between now and that third month, the exchange rate between the pound and the rupee will also move. And when it moves, I might be called upon to pay more in rupees, or I might be called upon to pay what? Less. That movement is what is called a transaction exposure. So the foreign transaction should be denominated in a foreign currency. And when it is being settled, it shouldn't be settled now, but it should be settled on a future date. Get it very clear. Translation exposure. You've seen it in your P2, International Accounting Standard 21, said that for you. When you are supposed to prepare a consolidated financial statement and you have a subsidiary or a branch that is located in another country and they have prepared their financial statement in a foreign currency to you, okay, then you have the translation exposure. I am based in the UK. I am the parent company, prepared account in pounds. I have a subsidiary in US that has prepared account in dollars because their functional currency is the dollar. When you are preparing the group account, you need to prepare the group account based on the presentation currency, which will be the pounds. I can't add this and that because one is pound, one is dollar. I would have to convert the whole dollar account into pounds before I will be able to consolidate. The moment the exchange rate moves, my asset values, my liabilities values in dollars will change in the consolidation account because this year I will use this year's exchange rate to convert. Next year, I will use the next year's exchange rate. If the exchange rate moves between this year and next year, obviously, my asset values and liability values are going to change. And that will be either a gain or loss. So the translation will come when you would have to prepare a consolidated financial statement to include a foreign subsidiary that has prepared accounts in foreign currency. My subsidiary can be in a foreign country, but their functional currency is still the same as my presentation currency. I'm based in UK, I prepare account in pounds. I've got a subsidiary in US, but that subsidiary trades more in UK. Their functional currency will also be the pound. And as a result of that, they also have to prepare the account in pounds. I haven't got any translation exposure because I don't have to convert any other currency into pounds, even though that subsidiary is in another country. So watch out, okay? Next one is the economic exposure. Economic exposure is also called the competitive exposure, strategic exposure, or it is also simply called the operating exposure. So many names. It is the long-term version of the transaction exposure. Why are we saying that? Every time I enter into a foreign currency denominated transaction for which the transaction will be settled on a future date, okay, I will have a gain or loss. So my cash flow will increase or my cash flow will decrease. We all said the value of the company is the present value of the future cash flows. Therefore, if the cash flow increase as a result of the exchange rate movement, my value of my company is going to increase by the present value of that extra cash flow due to the exchange rate. Okay, and that is what is called the economic exposure. So the short term of the economic exposure is the transaction, and the long term of the transaction is the economic. So the economic exposure measures how you can compete, because your objective is to maximize the shareholders' wealth. So as a result of exchange rate, if I am making losses and losses and losses, I can't compete in that market. I would have to get off there. That's why you see most of these car manufacturing companies, they don't produce and sell in one country. They've got so many plants in so many different countries in order to hedge against this economic world exposure. Simple example is, for instance, if I'm in UK and I produce car at 20 pounds, I don't even need a profit, and I'm selling it in US. Today, £1 is equals to $2. It means minimum, I have to sell it at $40. The next day, £1 is equals to $3. What should happen? I have to sell it at what? 60 for me to break even. Who will buy your product in US? Because today is 40, the next day is 60, the next day is changing. So you see your sales and everything is going to fluctuate. You can't compete in the US, because those companies which are in the US, producing in the US, when they peg it at 40 and you also peg it at 40 with them, you are competing with them. The moment the exchange rate change and you are going to 60, nobody will come to you, and as such you'll be out of the market. You cannot compete. It's not strategic enough. Okay, what is the relative importance of these different types of exposure to the financial manager? Okay, the question here is, with the financial manager, the objective is to maximize the shareholders' wealth, and to maximize the shareholders' wealth, all what we need to do is the present value of the future cash flows. Translation exposure has got nothing to do with cash flows. Translation exposure is accounting paper movement, and as such we are not so much concerned about it. What we are concerned about as financial managers will be your transaction and your economic, because it's got something to do with cash flows, and as such it's got something to do with the value. So if your objective is to maximize the shareholders' wealth, which is the present value of the future cash flows, you have to be so much concerned about the exchange rate movement and its effect on your cash flows. So that is basically that. How do we protect ourselves against economic exposure? How do we protect against economic exposure? There is a magic word here. That magic word is simply what? Diversification. We all said when we're doing the cost of capital and capping that when you diversify, you'll be able to reduce the unsystematic risk. So when you have economic exposure, it's a long-term issue. Therefore, diversify your foreign transactions. Okay, if I have to borrow money in foreign currency, I wouldn't borrow in one foreign currency. I will borrow in different foreign currencies. I'm based in UK. I can borrow in dollars, borrow in rupees, for instance. So that, for instance, if the dollar appreciates against my pound, it might be that my pound will also appreciate against the rupee, or vice versa. And the gain here will be used to combat the loss here. If you have borrowed in only one foreign currency and that currency appreciates against you, that is where you will see the loss. When you are producing, you do not have to produce in one country, sell in one world, other foreign currency. You have to spread it so that the loss in one currency will be combated with a gain in another currency. You can also use swaps, because swap is a long-term thing. So you can also use swaps. So you can write it there, even though swaps is somewhere. Because one of the questions, as I was saying, when he did the scenarios, identify those word exposures. And when you finish, you have to discuss how to hedge against or protect against what? Economic exposure. Talk about this diversification and also talk about what? Swaps. Okay, I think it was 4 marks. Diversification issue for 2 marks and the swaps for 2 marks. Okay, factors to consider before deciding protection against what? Transaction exposure. Do you have to hedge every transaction exposure? The moment you entered into foreign currency denominated transaction, do you have to straightforward hedge? The question is that you have to straightforward hedge, not necessarily so. Okay, these factors are what you would have to take into account in deciding as to whether you would have to hedge it or not. Okay, what are you hedging against? I am hedging against movement in exchange rate. So if I have entered into a foreign currency denominated transaction and that settlement will occur on a future date, I have got that transaction exposure. Will I have to hedge it? Whether I will hedge it will depend on those exchange rates. Are they volatile? If I have entered into dollar transaction and I'm based in UK and the payment will be made on a future date, my question is, should I protect the movement? I'm protecting against that movement in the exchange rate. So if the exchange rate between the dollar and the pound is not going to move, it's not volatile, why will I bother myself to think about that hedging? Because what are you hedging against? That movement is almost zero. Therefore, you are not likely to make any substantial gain or a loss. Forget about it. When you have to hedge, you have to use hedging instrument. Is there a market instrument available between the two currencies in there? If it is there, you use it. If it's not there, you forget about that. Obviously, you have to think about the commission or cost associated with the hedge. You also have to think about what will be the significance of that transaction to you. If it is just one-off transaction, I'm a multi-billion pound company based in UK and I buy one-off item from India for 50,000 rupees. Should I bother myself to go and hedge it? Okay, I don't, because what is 50,000 rupees to a multi-billion pound company? Why do you have to waste time and resources trying to hedge it? It's one off, just let it go. Okay, and sometimes it even depends on your attitude towards risk, because the movement could favor you. So maybe there's no need for you to think of what hedging and the expertise in your company. If you have got a qualified treasurer who can predict whether the thing will go in your favor, forget about the hedging and let it go in your favor. Now let's see how we will protect ourselves against the transaction exposure. Okay, to protect ourselves against transaction exposure, there are so many methods. We've got the internal techniques and we've got the external techniques. I'm quickly going to go through them. Internal techniques will be invoicing in your own currency. Okay, if I enter into the transaction, I will tell the other party, I want to pay you in my currency, or you have to pay me in my currency. If you will pay me in my currency, or I have to pay you in your currency, in the first place, I haven't got the transaction exposure, because that transaction exposure will come when the transaction is denominated in foreign currency to me. So if the transaction is denominated in my own currency, because I'm invoicing you in my own currency or I'm paying you in my own currency, I haven't got that transaction exposure in the first place. There's no need for me to hedge. This is the ACCA hedging strategy. Wherever you are in the world, you are paying your subscriptions to ACCA or exam fees on the basis of the pound. Think of, if ACCA is not using this basic hedging technique, what would have happened? Think of the different currencies they would have to be bothering their minds with. Okay, so that is the case. And always, if you are using this invoicing in home currency, it has got effect on competition. Because if you have to pay me in my currency, then I'm shifting the responsibility on you. Are you prepared to do that? You will only be prepared to do that if I have got the bargaining power. For instance, ACCA has got the bargaining power over you. So you can go and question ACCA, for instance, that why am I paying the pounds to you? In that case, if any time my currency depreciates against the pound, I have to pay you more. You are costing me more money. You can't do that. So if the customer has got the bargaining power, you the supplier, if you decide to use this method, the customer will switch. Okay, so watch out and the implication. Leading and lagging. Leading means speed up, lagging means delay. Leading means if you are expecting the exchange rate to move against you, speed up, pay early, or collect the money early. If you have to pay early, you have to take the money from your bank account. There's opportunity cost of interest forgone. If you have to pay early, maybe you would have to go and borrow. If you borrow, there's the cost of what? Interest that you are going to pay. So you have to do that cost benefit analysis in there. Lagging means delay. Delaying means you are not paying them early. If you are not paying them early because you are expecting the exchange rate to go in your favor, you will make the gain and the exchange rate, but you lose your credit worthiness. So all these are supposed to come into play before you come out and the final hedging technique. Netting. Netting is what I would have to say. Watch out for the calculation, and I wouldn't be surprised that you see netting in the exam room this time. Okay, netting. Sometimes people confuse netting with marching. They are different. F9, I'm happy for people to say netting and marching the same. But P4, they are different, so be with me. Netting here occurs when you are dealing with a multinational company. And of course, a multinational company has subsidiaries all over the world for which they have to trade among themselves in different currencies. So where there is a multinational company having subsidiaries and they are trading among themselves with different currencies, it doesn't pay for each of the subsidiaries to hedge individually. So the Central Treasury Department of the multinational company will try to set off receipts against what? Payment. And that is the netting. So netting involves setting receipts against payment in situations where there is a multinational company having subsidiaries and they are trading among themselves. We've got two types, bilateral and what? Multilateral. Bilateral means we've got only two companies involved. Here is more than what? Two. It's more than two companies. Okay. Netting. When you see netting in the exam room, you have to rejoice because it's very easy. Okay, so let's take this example to illustrate for the netting straightforward. Example 7. A group of companies controlled from the USA has subsidiaries in the UK, South Africa, and France. At 31st 12x3, intercompany indebtedness were as follows: debtors and creditors amount. It is the company's policy to net off intercompany balances to the greatest extent possible. The Central Treasury Department is to use the following exchange rate for these purposes: US dollar to the rand to the pound and euro. Calculate the net payment to be made between the subsidiaries after netting off intercompany balances. Okay, when you see netting questions, straightforward, you have to go through two stages. That's it. The first stage is that all the currencies there, you cannot set off against them. You can only set off two things when they are of the same base. Therefore, if they've given you different currencies as they've given to us here, okay, I can't set the rand against the pound. I would have to bring all of them to the same base. What will be the base? The base will be the currency of the parent company. Don't forget the presentation currency. So some of the questions, the examiner will tell you, convert them into that particular currency. If he doesn't, then you would have to convert it to the currency of the parent company. This question, the companies are controlled from the USA. So once they are controlled from the USA, then we would have to convert all these currencies into the pounds, to the dollars. So if we have to convert it into dollars, then what exchange rate should we use? Question had given us exchange rate here. What our advice is, if you go to the exam room, the exchange rate you would have to use depends on the question. Okay? If you look at all the recent questions P4 examiner has asked, all what he's saying is use the spot mid rate. Spot mid rate is telling you spot rate, as we saw, is given as the bid and is given as the offer. So this is your spot rate. Maybe your forward rate is also given. If it tells you use the spot mid rate, you take the bid, you add it to the offer, and you divide by 2. That is the bid rate. or the spot made red, and then you used it to convert the currencies. This question told us these are the exchange rate. This is another area the examiner can test you on the basis of cross rate. I need to convert all these into dollars. They've given me, let's say, US dollars to the rand, but they haven't given me US to the pound, but they've given me rand to the pound. I should be able to use that conversion to get the pound to the dollar. Okay, so open up your brain in here. But netting as it is very easy. Convert all the cash flows or the cash there into one currency, and that currency is the base currency. Unless otherwise stated, then it should be the currency of the parent company, which in this case is simply the US. So this is what we've done here. We converted all the currencies into the dollar. So this is in terms of the dollar. When you convert all of them into one currency, your next level is for you to think of which of these companies is receiving and which of them is paying. Be with me because there's a confusion here all over. So be with me. There's a confusion here. Debtors and creditors, who receives? There's a mistake in there. So be with me here. Debtors and creditors, who receives? If you are my debtor, it means I am your creditor. And for you to be my debtor, I have sold goods to you on credit. Are you supposed to pay me or am I supposed to pay you? You are supposed to pay me. So debtors pay and creditors receive. There's a mistake in there, so watch out here. Debtors pay. Because if you are my debtor, I will put you in my balance sheet as receivables because I have to receive from you. I'm your creditor. You will put me in your balance sheet as payables, creditors. Payable means you see that you have a liability. Therefore, once you have a liability, you have got the obligation to what? Pay. So when it's a creditor receives and a debtor what? Pays. So here, UK is a debtor. It means UK is supposed to pay South Africa. UK is supposed to pay France. France is supposed to pay South Africa. South Africa is supposed to pay UK. South Africa is supposed to pay France. So when you convert all of them to the base currency, now you have to set the receipt against payment. 2 stages. Convert to the base currency, set receipt against payment. Okay? You can do it in so many ways, but ACCA normally want you to do it in a matrix form. And the matrix form is just a tabular presentation as we have done. So it's your choice. You can say the paying subsidiary, read down. You are reading down for the paying subsidiary, and for the receiving subsidiary, you will say read across. Okay, read across. So that is the meaning in there. You can swap them. You can bring payment here and receiving there. It's your choice as long as one is there and one is down there. So the companies here are UK, US, and South Africa and France. Receiving UK, South Africa, and France. We say paying subsidiary, you are reading down. So if UK is paying, I am going this way. If UK is receiving, I'm going that way. I'm reading across board. Okay, so this is the case. So first, if you converted and you've got this money in dollars, UK is the debtor, so UK is paying the South Africa. Therefore, if UK is paying, I'm going to read down like this. If South Africa is receiving, I'm reading across. So where is the intersection? This is the intersection. That's why we put the figure in there. So UK, you read down. South Africa, you read across. This is where the intersection is. That's why you see the figure in there. Okay. Next, UK is paying France. If UK is paying, you read down. France is receiving, you read across. This is where the intersection is. You put the figure there. Next, France is paying South Africa. If France is paying, you're going to read down. South Africa is receiving, you read across. Where is it? This is where the intersection is. You put it there. Okay, so this is the matrix anyway. And then next, South Africa is paying UK. This is South Africa paying. You are reading down, and UK receiving. You are reading across. That is where the intersection is. Okay, and then South Africa is paying France. South Africa paying is down, France receiving is that. This is where the intersection is. You put it there. Okay, so when you finish posting all of them to receipt and payment, you need to sum up the total payment. Payment, we said you are reading down, so we're going to sum this plus that for UK, and that is what you get as total payment. This plus that for South Africa. This plus that for France. And if it is receipt, what will you do? You are reading across. So for UK, you're going to read it this way. UK receipt is based on this plus that, which is total that, to get the total receipt. South Africa, this plus that, you get the total. France, this plus that, you get the total. When you finish, you've got your total receipt, your total payment. So bring your total receipt down there because we need to get a net. So these total receipts are what we've brought here. This, and that. Okay. And as such, you need to remember your total receipt should be equals your total payment. So netting, you should be able to mark yourself. This one is going to be 0, straightforward. If you don't get 0, something is wrong somewhere. So UK is supposed to pay a total of that, receive that. Payment is more than the receipt, so there will be net payment. South Africa pay, receive that. Receipt is more, they will receive. The same applies to France. So UK is supposed to pay this to France and then to pay that one to South Africa. That is basically the case. And the netting, you reduce the number of transactions in order to reduce transfer fees and hedging costs. Okay, that is the benefit of you doing the netting. So that is basically netting. When you see netting, it's receipt and payment. The only thing is that first convert every currency to the base currency, typically the currency of the parent company. Matching occurs where there is one company, and that one company is buying and selling in the same foreign currency. Here there is no multinational. That's why F9 they said, matching and netting the same, because you are setting receipt against payment. But technically, when we say netting, it's for multinational company. Matching is for one company. I am based in UK. Let's say I buy raw materials from India. I also sell some of my product in India. I will get receipt in rupees. I'll have to make payment to in rupees. What will be the common sense of me converting the rupee receipt into pounds? And when I finish and I have to go and pay rupees, I convert the pounds into what? Rupees. The bid and offer. The bank manager will make the spread off me because he will change this at the higher rate and give it to me at a lower rate. That is how it goes. So matching, you set receipt and payment against each other of the same currency. And to facilitate this, most of these companies will establish or open a bank account in that foreign currency. So I have got a rupee bank account. All my rupee receipt goes in there. All my rupee payment goes out of that. And the only difference is that the difference in there in rupees, I have got a translation exposure, which does not involve any movement of cash. So that is basically the internal. Now let's go to the external techniques. The external techniques, before then, all what I will tell you and the calculation and the internal is only the netting. The rest you are going to write. Okay, so the netting is only the calculation the examiner might ask you so far as the internal is concerned. Then external techniques, we can use the forward contract, money market, currency futures, currency options, and currency swaps. Okay, your note is prepared such that this chapter is looking at forward contract and money market hedge. Okay, the other chapters will be looking at the currency futures and currency options and the swaps. Okay, so what is forward contract? We all know that forward rate is the rate that is determined now for exchange to be done on a future date. So if I have to receive money or pay money on a future date and I'm worried about the movement in the exchange rate, all what I have to do is I go to the bank today and fix the forward rate today so that the actual exchange of the currency will be done on that future date I'm expecting to receive or pay the money. So let's take these examples to illustrate. Consider the following exchange rate. Forward contract is there for 1 mark, and that 1 mark is more to do with bid and offer. Okay, so consider the following exchange rate. Spot 2 month forward, 3 month forward. A UK company is expecting to receive $100,000 in 3 months time from the group goods supplied to a USA company. What is the sterling receipt if the company decides to hedge using a forward exchange contract? Okay, all what you need to do is come here. What is your date? I am expecting to receive the 100,000 in 3 months time. So you have to go and enter into 3 months forward. Would I use the bid or will I use the offer? Look at the quotation, $/pound. The pound is the base currency. Dealer says, I buy pounds from you at the bid. I sell pounds to you at the offer. If 3 months time, I will get $100,000 to be converted into pounds. It means if I go to the dealer, what is the dealer going to do to the pound? Is he going to take pound from me or is he going to give? He's going to give me pound because I'm giving him dollar for him to give me pounds. Therefore, I have to fix the rate at the offer. That is the reason why they fix it at the offer. And whatever the exchange rate will be in 3 months' time, we are not worried about it. No, because we have actually agreed on this particular rate. So whatever the exchange rate will be, we will exchange it at $1.55 to the pound. So there is a guaranteed receipt of 64,516. Whatever the exchange rate is, we have to get the 64,516, and we are not worried about the movement in the exchange rate. Example 9, a company expects to receive 10 million in 2 months time. Exchange rate are as follows. Spot 1 month this, 2 month this, 3 month this. This year means discount, and look at what they've done here. These are points. Okay, how are we going to use forward contract to hedge this? To use the forward contract to hedge, we need to know which forward contract. When are we supposed to receive the money? 2 months. So I have to enter into 2 months forward contract. And that 2 month forward contract, they gave me the rate in point. So giving me the rate in point, I cannot use the point. I would have to convert from point to the outright, and we said the point is a deviation from the spot. So bring your spot and you ask yourself, these are the point. The point, are you premium or are you discount? If it is discount, in this case, I have to add. So that is why they are adding for you. If it is a premium, we would have to deduct. Okay, and you know how to do it. That is what we did up there. You pick the 600, you match them. Okay, you pick the 400, you mark them, 0 that, and you add. So this is the forward outright quotation. And when I get the outright quotation, I need to ask, am I using the bid or am I using the offer? Because I'm going to receive the $10 million, I will go to the dealer with what? The dollar. And the exchange rate is quoted $/the pound. Therefore, the base currency is the pound. The dealer will offer me the pound. He's not taking the pound from me. He is offering me. So we have to use the offer rate, and that will give you a guaranteed receipt of that. Okay, so when you are there at your time, try this one. Try this one to see if you'll be able to get that. What is the implication of using the forward contract? The implication of you using the forward contract is that it is an obligatory contract you have to honor. So for instance, the example that we did here, we said we are expecting to receive what? 10 million. So we entered into this contract. It is obligatory that in 2 months time we have to go and give the bank the 10 million for the bank to give us the 5.8 million. So if whether our customer give us the 10 million or not, the contract is between us and the bank. The bank hasn't got any contract to do with our customer. So the bank will expect us to bring the $10 million for them to give us the 5.8. If we don't bring it, because it's obligatory, the bank can pursue it through court to get the money. So all what they are trying to tell you here is that forward contract is basically obligatory. Now let's look at the money market hedge. Let's look at the money market hedge. Okay, let's look at the money market hedge. What is a money market? A money market is a market where you can either borrow or lend on short-term basis. So we are going to use the principles of borrowing and lending as a way of combating the exchange rate movement. It is either you going to receive, I'm just doing it stereotype for you, or you are going to pay. The common sense is, if I am going to receive the money in a foreign currency in a future date and I'm worried about that movement, what can I do? Hedging is basically you entering into a counter activity in order to eliminate or remove or reduce an exposure. That's the meaning of hedging. Okay, so if I have to receive money in foreign currency, let's say dollars, and I'm based in the UK, I have a debtor, so I have to receive the money from him. So if I have a debtor, I have got an asset. And once I've got an asset, I have to enter into a counter activity. And that counter activity is that I have to bring a liability by going to borrow. So I would have to first borrow. The amount I have to borrow should be equal to the amount borrowed plus the interest on that amount should be equal to the amount I would have to receive. So if I have to receive, let's say $100, I will borrow about 95 on the assumption that the interest over the period is equal to what? 5. So that when I borrow that amount, interest on that amount will be equal to the total receipt. I'm matching my receipt against my payment. Full stop. When I borrow, I have got the money with me. So what will I do? I will convert into my currency. And then when I bring it into my currency, you don't put it under your pillow, you deposit it at the bank. So you deposit it, okay? And the last day, let's say in 2 months' time, I go to the customer who is owing me this money. I go and get the receipts. If I get the receipt, I come to the bank manager that I borrowed the money from. This is your principal I borrowed. This is your interest. That interest plus that principal was equal to that receipt. And I haven't got any currency to bring back. The next level is that if it is payment, it means I have a liability. The counter will be to create an asset. So first, I would have to go and deposit. Okay, how much I will deposit? Okay, how much will I have to deposit? The amount I have to deposit will be that when I deposit that amount plus the interest on the deposit I will get will be equal to the amount I would have to pay. So this moves with that. It's opposite. Then the next is that you need to convert your money and then you need to what? Borrow. So it turns upside down. But the common sense is the amount you need to borrow depends on the amount you need to what? Deposit. So it's like you are borrowing the amount in your country, convert it into the foreign currency, go and deposit it, earn interest, and go and pay the amount at the end of the period. So let's take these questions to illustrate. Let's take this question to illustrate. So example 11, a UK company export goods to a number of companies in the USA and Europe. It is due to receive 100,000 in 3 months' time from the goods supplied to a USA company. The 3-month forward rate is 1.4550 to 1.46, and the spot rate is 1.4960 to 1.4990. Actually, the quotation is dollar/the pound. The interest rate available in the money market are UK and then the US. How do we use the money market to hedge? Because I am going to receive, I would have to actually go and borrow. I'm going to follow this. So I will say I need to borrow. How much money I have to borrow? The common sense is your future value should be equal to your present value 1 plus the interest. Don't copy this. I just want to lead you to a formula. So the future value, this is the money I have to receive in the future. So I will borrow an amount now, present value, so that that amount plus each interest will be equal to the amount I have to get in the future. So what then will be the present value? That present value should be the future value 1 plus R. So the amount you need to borrow is not all this, just put it straight. The amount you need to borrow should be equal to your exposure, which is the future value, divided by 1 plus R. I was trying to use this to do that. Some of you use box to do it. I don't follow the box approach. I follow the principle and move on. You can still use your box approach. They will say, find the present value. How did you get a present value? This is the common sense. So the amount I need to receive in the future is $100,000. I need to divide it by 1 plus the interest. I am going to borrow from the US. So if I'm going to borrow from the US, what is the borrowing rate? 14% per year, but it is for only 3 months. Therefore, I would have to say my R will be the 14% multiplied by 3 over 12. And that 14 by 4 is given, is it 3.5? So 1.035%. And how much dollars am I borrowing? So 100,000 divided by 1.035, and that is 96,618. So when I borrow 96,618, I have got that money. I would have to convert the 96,618 into your sterling now. So at spot rate. What spot rate? Because I will go there with the dollar, he has to offer me the pound, so I have to offer it. Therefore, I will say 96618 divided by what is the spot rate, offer rate. The spot offer rate is what is given here as 1.960. So I will say 1.4960. Let me be sure of it. 4960. So 4960, how much pounds will I get? 1.4960, and that is 64,584. And when I get this money, I would have to deposit. When I deposit in the UK, I will get this money of 64,584 plus the interest on it. If you deposit in the UK interest rate, when you deposit, you have to get a lower rate. When you are borrowing, you have to pay the higher rate. That is why here we pick the 14. I'm depositing here, so it should be 6%. Okay, so 6%. So 6% multiplied by 3 over 12, 6 by 4, is it 1.5%? So 1.015. 1.015, and what will be the total amount in pounds? So 64,584 times 1.015, and that will give me 65553 approximate, and that is the end product. And this is what you have to compare with forward rate and a forward contract and other contract. Okay, so this is the receipt. So if we go to our note, the next example there is example 12. Assume the same fact as example 1 above, except that the UK company is making payment of 1 million. Okay, if you are making payment, you would have to go and deposit. Now flow with me. How much should I deposit? The amount I have to deposit should be my exposure divided by 1 plus R. If you are going to deposit money in the US, you have to pay you have to get the lower rate. They gave 11% and 14%, so that is the 11% divided by 4, because you are depositing for 3 months, which is 3 divided by 12, and that is the 11% divided by 4, and then you will get the 97. Here, I have to change it. It's not convert this amount to sterling at the spot rate. No. You haven't got this money. You are going to deposit the money. So you say convert pounds into this amount of 97326.01, because you are going to deposit. So you are borrowing the money from your country. So it has effect on the bid and offer, because if I'm converting the dollar to pounds, it means I will go to the dealer for pounds. He has to use the offer. But here, that is not the case. I'm converting my pounds in order to go and deposit it in that country. So I will go there with pounds. The dealer will buy the pounds for me. That is why they are using the bid rate. That's why they are using the bid rate. So when you use the bid rate, it's 1.4960, and then that will give you that figure in there, isn't it? That will give you that figure. And then when you borrow, the next step is that you need to borrow. How much am I going to borrow? So when I borrow this money, I have to pay interest on that. The higher rate in the UK is 9%. So that is the borrowing rate. Divide by 4 because it's for 3 months. And that will give you the total amount you would have to what? Pay. So this is the common sense. Okay, so the question here is a homework you would have to try. The question here is a homework you would have to try. We are converting. They've given you your closing rate. Don't forget about the daily spread. They've given you your closing rate of the exchange rate. They've given you 3-month forward rate. This is CPM. It's currency at a premium, currency at a discount. How will you convert these into the outright? If these are the spot rate and they've given you the point, how will you convert it to outright? We know how to do that one already, so I do not have to bother myself again going through that. It's for practicing. And then they've given you this. You have to use the money market. You have to use the forward contract, which I think it should also be basic. So I am going to move you to interest rate risk, straightforward, even though I have got only 10 minutes. So let's see how we can do the interest rate risk quickly. So hedging interest rate risk, hedging interest rate risk. Okay, just as we saw in currency, interest rate risk is coming as a result of movement in interest rate. The moment interest rate moves, I might be called upon to pay more, or I might be called upon to pay less. For instance, I need to borrow money in 3 months' time. Today, the interest rate is 10%. And in that 3 months' time, when I went there, the interest rate has gone to 12%. I'm going to say, oops, something that I could pay 10%, I'm paying 12%. So I'm losing by 2%. Or today is 10%. In that future date, it is what? 7%. I am going to be happy because I'm paying less of 3. So the moment you are standing here and you are supposed to transact on a future date by borrowing or investing, the moment the interest rate moves between now and then, you will get more or you will get less, or you pay more or you pay less. That movement is what is called the interest rate risk. Obviously, nobody is going to tell you to define what is interest rate risk, what is LIBOR and LIBOR. Nobody again is going to ask you to define what is LIBOR and LIBOR, but it is in your questions. LIBOR is London Interbank Offer Rate, and LIBOR is London Interbank Bid Rate. Okay, it is interbank rate. Basically, is interbank rate, and that is the rate that the banks will pay among themselves. So LIBOR, if one bank is going to borrow from another bank, they would have to pay the LIBOR. If one bank is depositing in another bank, they get what is called the LIBOR. And of course, your deposit rate is less than your borrowing rate. So LIBOR is the interbank borrowing rate, and LIBOR is interbank deposit rate. So normally, the examiner will tell you, if you are going to borrow as a company, you don't pay the bank rate, because the bank that you are borrowing from will pay the LIBOR, and the bank is supposed to charge you a premium to compensate for your risk, which is your business risk and financial risk, going back to cost of capital. So sometimes, instead of the examiner telling you to calculate the cost of a debt using the internal rate of return and all those methods we learned before, the examiner is just going to make it simple for you that you will borrow at LIBOR plus, let's say, your spread. And the spread is normally said to be on basis points. and basis point is always reflected to 100. So when I say 200 basis point, you borrow at LIBOR plus 200 basis point. This basis point is reflecting your level of your business risk and then your financial risk. And that level of your business risk and your financial risk is what will determine what is called your credit score. The more risk you have, the more your credit score is going to be low, and the more you are risky and the more your spread is going to be. So the examiner can even tell you that, oh, your company is BB rated. If your company is BB rated, the credit spread of a company which is BB rated is 200 basis point. What has he told you? You are borrowing at the LIBOR plus that 200 basis point, and that 200 basis point is reference to the 100. Therefore, it is like you are borrowing at your LIBOR plus 2%. When I say 50 basis point, you are dividing by 100 and it will be 0.05%. Okay, so this is how sometimes the examiner will ask you to calculate the cost of debt. I have been receiving questions from some of you which I have explained all this already, okay, in those questions that you send, which is very great. But this is where actually we are supposed to learn that. So your LIBOR plus your spread, your LIBOR plus your spread should give you the cost of the debt, full stop. Because we all said from capping, you pay the risk-free rate plus your risk premium to compensate for your business and financial risk. And that risk premium determine your credit score, and as such, it will determine the score, and which will determine your spread. And for that spread, they will give you the spread according to your credit rating. Okay, so that is basically done. Okay, term structure of the interest rate. Let me explain that quickly. Term structure of interest rate. What do we mean by the term structure of interest rate? There is a relationship between time and interest rate. For all other things being equal, that means if we hold everything constant, the longer the period, the more the risk and the more interest you are supposed to pay. So the term structure of interest rate is telling us simply, the longer the period, the higher will be the gross redemption yield or the return on that particular debt instrument. And that term structure of interest rate is represented on the yield curve. And the yield curve is just telling you the normal yield curve is positively sloped, telling you that the longer the period, the higher the interest rate. And that return is what we say the gross redemption yield. This is leading you towards something. Nobody is going to ask you to define these. No way. Okay? We also have what is called the inverse yield curve, which is the abnormal, telling you that under certain abnormal situation, the shorter the period, the higher the interest rate. Okay, and the shape of the yield curve is simply explained by the liquidity preference theory, the expectation theory, and the market segment theory. Okay, we are leading you towards something. This is what you saw in F9 as discussion. At P4, nobody is technically going to ask you to do this, but we need its application coming. So liquidity preference theory is just telling you straightforward that investors will prefer to have liquid money. We all want to have money on us. So if you want me to give that money to you, you are depriving me of what I prefer, because I prefer to be liquid by having that money. So the longer you deprive me from me being liquid, the more you would have to compensate me. Otherwise, why will I have to give the money to you? So we will prefer to have money on us, and the more you would deprive me from having my money on me, the more I am making a sacrifice to you, and therefore the more you would have to compensate me before that. So just have a look at this. We are leading you towards something good. Okay, this is why the yield curve is there. Nobody is going to ask you to explain what is the yield curve. This is why the yield curve is there. So let me use it to illustrate bond valuation and bond yields. Okay, last week we did valuation of bonds, and we said where there is a plain vanilla bond. Somebody will ask, what is plain vanilla bond? There are so many types of bonds. A plain vanilla bond are those bonds when you buy, you get interest every year, and then at the end of its life, you get the redemption value. That is the normal bonds we know. Because some of the bonds outside there, when you buy, you don't get interest every year, and at the end, you get a redemption. It could be that that amount will be paid in equal installment, for which some of the monies paid or the installment paid, some will go towards interest and some will go towards principal. Your syllabus wants us to see valuation of bonds where you are getting interest throughout, and at the end of the period you will get your redemption value, and that type of bond is what is called the plain vanilla bond. And last week we said the value of that plain vanilla bond is the present value of the future what? Cash flows discounted using the cost of the capital, which is the redemption yield or internal rate of return. So we are developing you to something. So let's take this example. A company has issued some 9% bond which are redeemable at par in 3 years' time. Investors require an interest yield of 10%. What will be the current market value of 100 of the bond? This is the normal one. Okay, so we will say interest is 9%. 9% of the nominal not given. It should be, oh, even here was given 100. 9% of 100 is 9. Forget about the net because there's no tax. Okay, then redemption value is at 100. What will be the present value? I need the discount factor, which should be the internal rate of return or the cost of the debt, which is the yield or return on the debt, which is 10%. I discount it at 10%. I get this market value, which everybody knows how to do that. This is what we did last week. Okay, next, how do we calculate the cost of the debt? The cost of the debt, we said, is calculated as the internal rate of return. If it is redeemable, we've seen it long time ago. Here, we are just bringing your mind on before we move you to the next level. Otherwise, we can refer you back. So be with me here. The name of internal rate of return is also called redemption yield, yield to maturity, required rate of return. That is the internal rate of return. So many names is given. Okay, what is the internal rate of return or cost of the bond? We know how to calculate. We said a 5.6% bond is currently quoted at 95x interest. It is redeemable at the end of 5 years at par. Corporation tax is 30%. Calculate the gross cost of debt. Because they say gross, I have to forget about tax in the argument. So to calculate the internal rate of return, I need two MPVs. To get the MPV, I need number of years, I need relevant cash flows. How many years? 5 years. So we're going to say year 0. What is the market price? Question said is 95. What is the gross interest? Because I want the gross redemption yield. The whole argument here is the interest is 5.6. 5.6 of 100 will give you 5.6. Redemption value is 100. You choose your own two discount factors. We are calculating internal rate of return, remember? So the note chose 5% and the 10%. Discounted, we've got the two MPVs. Okay, this one is supposed to be here. Getting the two MPVs, you put it in the internal rate of return formula. Everybody should be able to calculate this by now. If not, then it means you are not learning, because we've done this long time. We are pushing you to the next level. That's why we brought there. So 5% is the lower rate. MPV of the 5, MPV of the 5 minus will give you positive of the MPV of the 10. 10 minus 5, and this is the 7%. So this is what we have been doing to calculate value of a bond and the cost of a bond. Now let's see something. Let's come to reality. This 7% is the gross return you are making on the bond, and this bond is for 5 years. Does it mean that every year you are going to make 7%? If I have got a bond for 5 years, does it mean every year I'm going to make a return of 7%? That is not the case. The internal rate of return we have calculated so far as the cost of the debt is the average return you are making over the period. is the average return you are making over the 5-year period. It does not mean every year you made 7. The annual average return, weighted average return, is that 7%. Look at the formula. Weighted average return is that 7%. It doesn't mean every year you made what? 7%. And this brings us to the next level, and that is called valuing the bonds based on the yield curve. Okay, it is very easy, but most students dodge when they see that question. Valuing a bond using the yield curve, it is something so special to them, but it's very, very easy. We all said the value of a bond is the present value of the future cash flows discounted using the cost of the bond. Yield curve, as we saw, gave us the redemption yield. Let me bring your mind on. That is the reason why those diagrams were there. If you look here, have you seen gross redemption yield, which is the same as the internal rate of return? So this is telling you a bond of 5 years will have a return of this rate here. This rate here, 10 years, or let me even do something in here for you. So when I tell you that this is my yield curve, for instance, and I do this, this is year 1, year 2, let's say year 3, year 4, and then this is, let's say, 5%, this is 6%, this is 7%, this is 8%. I'm using hypothetical figures. Bonds of the same risk will have their same yield curve, because risk is what is used to determine the return. So if bonds are of the same risk class, they would have to have the same return. So this yield curve is telling you, if I have got a bond of this risk class level and that bond is 4 years, the first year of the bond life, I'm making a return of 5%. The second year of the bond life, I'm making a return of 6%, 7%, and 8%. So every cash flow I will get in year 1 should be discounted using the cost of the debt in year 1, cash flow in year 2, cash flow in year 3, and cash flow in year 4. So basically, you are not discounting the cash flows year 1 to the end of the period using the average return, which is the weighted average of all this, which is the internal rate of return. But because they've given you the yield curve, you have got the return for each of the respective years, and that is what you would have to use to calculate the value of the bond. So nothing has changed. We are calculating the present value of the future cash flows. The only thing that has changed is we don't have one cost of capital. We don't need the average cost of capital because they've given us the return for each of the respective years involved. So let's do this, and then our time is up. Next week I will pick it from there. Okay, and that will be the best point for us to leave, because I will push you to the next level. Think about it, and then we take it from there. A company wants to issue a bond that is redeemable in 4 years for its par value or face value of 100, and want to pay an annual coupon of 5% on the par value. Estimate the price at which the bond should be issued and the gross redemption yield. The gross redemption yield is the average. The annual spot yield curve for a bond of this risk class is as follows: year 1 up to year 4. Therefore, every cash flow I will get, year 1 should be discounted at 3.5. This is 4, this is 4.7, and 5.5. When I sum, I've got the market value of that bond. So this bond is having interest rate of 5%. 5% of 100 will give me 5. You can't think of using annuity here because the percentages are going to change every year. So year 1 up to year 4, year 1 I will get interest of 5, interest of 5, year 2, interest of 5, year 3, year 4 I will make the 100 plus the 5, which will make the 105. What discount factor what we were doing, we were discounting using the average return, which is the internal rate of return. No, this time, because they've given us the specific rate for each year. That's why the yield curve was there for you. So these are the rate. So year one, we're going to say, I have to discount it using 3.5%, and we all know it's 1 divided by 1 plus r raised to the power n, or 1 plus r raised to the power minus n. So the r for year one is 3.5, which is 1.035 raised to the power minus 1. Here is 4. 1.04 is 2 years, so raise the power minus 2. 4.7, 1.047 raise the power minus 3, and 1.055 raise the power minus 4. You discount them, you come and get what? The present value. When you sum up that, it gives you the market price of that particular bond. That's it. So it's just like you doing your present values given the yield curve. What I can say is the examiner might not necessarily present the yield curve like this. The examiner can present the yield curve the way I've done it. So some of the questions, you see the examiner has done that. Okay, drawn the yield curve for you. You would have to pen them like this and see what will be the corresponding rate to get the 3.5 blah blah blah. He might not necessarily give it to you in that format. He can draw it. You would have to what? Pen them and see year one, what is the corresponding rate? Year two, what is the corresponding rate up to year 4? How will we calculate the internal rate of return, which is the weighted average? So having got the market price of this, this is the market price of that. Then year 1 to year 4, my gross interest is going to be 5, and I'll have redemption. I have to assume the 2-word rate. And when we assume the 2 rate, we have got the average return of 5.46. Look, none of the figures here is related to the 5.46. This 5.46 is the weighted average of the returns I'm getting. Is the weighted average. It's not simple average that you add them and you divide by 4. No, it's the weighted average. Okay, so this is the weighted average return I will get over the life of the project. Okay, so watch out. The next time is estimating the yield curve, which I'm going to pick it next week. Estimating the yield curve is a simple change of subject. Giving you, if I've given you, look at what we did here. If I've given you this 5 and I've given you this present value and I tell you to calculate the 3.5, you should be able to do the change of subject. That is what we are going to do next week. That is the reason why I want to peg you up to this level, so that when you go through this and I pick it from there next week, you will be able to flow with me. So thank you very much for your time, and I will see you next week. In the meantime, any questions that you have, send them. Those who are sending, I'm encouraging you, send more. Those who haven't, please, I'm waiting for you. You need to start practicing, okay? So let me see you, and let's practice the questions. So if I haven't got any question, I will thank you very much, and I'll see you next week. Thank you.